Hello, everyone. I hope you're all doing well, and we appreciate you joining the webinar today. I'm Sourav Srimal, in charge of data at Solve Advisors. For those that do not know Solve is a leading market data platform provider for fixed income securities. Industry-leading firms trust Solve market data platform powered by deep market insight to reduce risk for securities investments and save hundreds of hours in pre-trade and post-trade research and validation. We've got a very interesting format for our webinar today. Nicholas, Marshi, and I are going to be discussing relevant topics around private credit, direct lending, and BDCs. I will also be showing you some very interesting data about private credit and BDCs drawn from our huge reservoir of data, which will enhance our conversation. During the webinar, we are also inviting our listeners, you, to send us your questions. Nick and I will do our best to answer them. In the BDC space, leveraging Solve's AI/ML technology has been a game changer. Accurate filing data is now available within minutes of filings for hundreds of BDCs, both public and private. As a result, users have access to the names of every company, every BDC that has financed for every quarter, the type of loan, equity investments involved, the interest rate, the cost, and the fair market value, all in reverse chronological. A real amalgamation of data which can be mined in infinite ways. Before we get into all that, I want to introduce our guest, Nicholas Marshi, the publisher of BDC Publications and the editor of the BDC Reporter, the leading publication providing news, views, and analysis about the BDC sector for an institutional audience. He made me say, Solve republishes the BDC's Reporter weekly commentary, recapping what's happened to BDC common stocks on our website. We've known Nick for several years, ever since he began using Solve's BDC database, and he's been a frequent speaker on our prior webinars as well. Recently, Nick has launched 2 new publications, which he'll be telling us about. Nick, can you please say hello to our listeners?
Oh, hello, everyone, and thanks for making the time to listen to what I hope will be an interesting conversation.
Also joining on today's webinar is David Diggins, our Director of Marketing, who's coordinating the webinar. Will ensure all the slides from today's presentations are distributed later today. So before we get to the matter at hand, Nick, would you like to tell us about your new publication?
Yes, Sourav, and thanks. We launched BDC Credit Reporter a few months ago because we felt there was a great need for an independent and objective source of credit information about underperforming and non-performing BDC finance portfolio companies. The BDCs themselves publish quarterly valuations of every company they invest in, all of which can be found on Solve's database. That's our starting point, and from there we provide the backstories of hundreds of underperforming companies. Basically, we're trying to assess what ultimate credit losses might be. And after all, credit is job one for any leverage lender. I like to think we provide a unique insider's perspective on BDC credit, and I encourage you to check us out. Our other publication, BDC Best Ideas, is very different. We take everything we've learned from analyzing BDCs in the BDC Reporter and the BDC Credit Reporter, and we offer up our view on which public BDC stocks and bonds make the best buys right now. If you'd like to read any of our publications, just sign up. Anyway, that's enough about us. Back to you, Sourav.
All right, so the key issue we are going to discuss today is whether the Fed's imposition of record high interest rate will result in boom or bust for private credit lenders generally, and for the BDCs particularly. However, before we get to that hot topic, I'd like to show everyone some fascinating data Solve has assembled that shows how private credit has gone from a niche in the financial markets to an asset class of its own. According to The Economist, private credit assets under management have jumped from 250 billion in 2010 to 1.4 trillion currently. The BDC sector, though, has grown even faster, more than 12-fold, as you can see here, which shows 270 billion in BDC's assets under management as of third quarter 2022. That's 29% increase in BDC's AUM in just 9 months. That comes from both an influx of new private BDCs and asset growth amongst the existing public BDCs. Since 2018, the number of total BDCs has increased by nearly 40%, even though the number of public BDCs has shrunk as bigger players have swallowed up their smaller BDCs. So, Nick, what's your view? Do you think private credit is going to continue to grow? And what will happen to the size of BDC sector?
Well, Sourav, not a week goes past without us hearing about a new or existing credit manager launching a new private credit fund or expanding an existing vehicle. What we call the great displacement of the banks from the leveraged loan markets shows no sign of abating. Ares Capital, on its most recent earnings conference call just the other day, quoted an LCD report which indicated that 98% of all new LBO issuance in the fourth quarter of 22 was completed by private capital providers as opposed to the syndicated loan market. That may be an extreme example, but the shift from banks to non-banks is a secular trend that's very unlikely to change. So we expect that 1.4 billion in private credit assets to only increase. The BDC's share of the growing private credit pie is also likely to grow. Capital is just being raised like topsy in both the private and the public side of the BDC market. We focus mostly on public BDCs, and already this year we've had 2 public BDC equity secondaries from Ares and Pennant Park. And many more BDCs are constantly raising new capital from their aptly named ATM programs. Sourav, I wouldn't be surprised to see that chart of yours show $300 billion in BDC assets under management by the end of 23 or end of 24. I think it's fair to say that in almost every market segment, BDCs are already the go-to resource for borrowers seeking private credit.
Thanks, Nick. So very quickly, let's chat about a BDC's asset quality. And my question to you is, how does it compare to the great financial crisis? And should the investors in the BDC space be worried about asset deterioration in 2023?
Well, for anybody who wasn't around BDCs during the Great Recession, let me quickly recap what happened to BDC asset values. They got crushed. Huge permanent losses were incurred by BDCs of all sorts, causing most of them to reduce their distributions or suspend them entirely. Many BDCs never recovered, and it was all due to those credit losses. Thankfully, today's BDC investment assets are very different. Back then, the bulk of BDC assets were in equity investments or junior capital like subordinated debt or second lien loans. The BDC sector was still getting going, and that's the sort of role the sector played, providing higher risk capital to the sponsor groups. Today, as your chart shows, Sourav, most every BDC has realized that's not a long-term formula that works, and they've migrated up borrowers' balance sheets. BDCs are now predominantly secured first lien lenders. But that's just part of it. BDC portfolios are much more diversified than they were before. Their managers have much more control over the restructuring process when that's needed, and they play an ever more central role with PE sponsors and borrowers. Now, that doesn't make BDCs invulnerable. Bad things still happen, but they're in a much stronger position than 15 years ago.
So we are in a unique environment, in my view. Just as the US and global economy look set to enter a recession of unknown duration and magnitude, interest rates are still increasing and reaching levels we've not seen in years. The question on everyone's mind is how private credit and BDCs will navigate that challenge. Are we going to have a tsunami of loans going on non-accruals like we did the last time we had a global recession in 2008 and 9? I must say, looking at our data, our recent data for BDC's non-accruals, that the percentage of non-performing assets seems very low. Historically, non-accruals has been around 2.5%, and as of third quarter 2022, as data shows, non-accrual is at only 1.1% of AUM at cost. Nick, do you anticipate an uptick in non-accruals?
Absolutely. Non-accruals are going to be going way up, but that's not as bad as it sounds. So look, we've had 2 very good years thanks to the Fed of very low levels of non-performing loans. In fact, many BDCs have managed to book more profits and losses thanks to a hot market. For example, in 2021, 3/4 of the public BDCs we track reported higher NAV per share than in 2020. To predict that matters are going to get worse going forward from a credit standpoint is not a difficult or unusual call. That's what all the rating companies are doing, like Fitch, S&P, and Moody's, and just about every analyst, commentator, and pundit. What BDC investors need to know, though, is not if BDC defaults and bankruptcies will be higher, but whether actual permanent losses of capital and income earning ability is going to be material. So let's just find some terms. We'd say credit losses are material if net realized losses amount in a 12-month period to greater than 10% of a BDC's book net worth. If losses amount to 20% or more, that's truly problematic. Below those levels, we'd say losses were manageable. It's a term we borrowed from Ares Capital. Now, over at the BDC Credit Reporter, we have a window seat to what's happening to BDC credit conditions. As you might expect, we noticed a pickup in the number of troubled companies starting in the second quarter of 22, which continued in the third quarter and the fourth quarter. And most recently in January and the first few days of February of 23, we've been noticing an even greater deterioration with more leveraged companies getting into trouble and those already into trouble getting in deeper. There have been 5 BDC finance bankruptcies in this year and 25 non-BDC financed company bankruptcies this year that we found. This is showing up in more non-accruals, bankruptcies, and restructurings. You might have heard data from Bloomberg yesterday indicating that large corporate bankruptcies in January were higher for that month than at any time since 2008. Chances are very high that this will continue well into 2023, whatever the Fed does. However, at this stage, we foresee that most BDC losses will remain modest, although a handful of BDCs may do worse. We retain the right to change our minds as the data changes, but that's our view at the moment. Expect more defaults, more non-accruals, more credit dramas in 2023 than in 2022, but not a repeat of the crack-ups that occurred in the Great Recession. And at the end of the day, this will be manageable.
Thank you, Nick. As this chart shows, data pulled from Solv's database, that BDC loans with payment in kind feature have greatly increased in number over the years and now accounts for 1/10 of all BDC's investments at cost. Is that something we should be worrying about, especially if we are getting into recession?
Yeah, that's very interesting data, Sourav. Yeah, PIK income can be controversial. I mean, after all, a BDC is booking into income and paying itself fees on paper income that might not be received in cash for years, sometimes many years. But to everything, there is a silver lining, though. In 2023, I expect that PIK income will increase as BDCs allow more and more borrowers to pay some of their higher interest costs in PIK form, which will reduce their cash debt service. Down the road, as rates drop, most of that PIK will be collected by the BDCs. I think this will be a win-win for lenders and borrowers who take the long-term view. Would anyone rather the companies defaulted due to a temporary hike in rates?
So I know, Nick, you've been tracking BDCs for a very long time. Will the portfolio companies tap into their undrawn revolvers in 2023?
Yeah, analysts and investors look to borrowers drawing on their revolvers as a canary in the coal mine where liquidity is concerned. I think that's probably why you're asking me. Back in 2020, revolvers were drawn down by many BDC borrowers in an excess of caution because they were worried about future liquidity. But those revolvers were soon repaid as the Fed effectively became the whole economy's lender of last resort. The current situation is nothing like that, and revolvers have been largely left untouched. There's no sign that borrowers are panicking, even though we've been promised a recession for the last 12 months. Keeping an eye on revolver draws is still a useful thing to watch out for, but this canary is very quiet right now.
So let's drill down a bit and talk about one of the biggest sectors into which the BDCs lend, Technology. I've noticed, like everyone else, that higher rates has caused the public tech sector to get crushed. IPOs are down, valuations are down, company formation is down, and now we're seeing many layoffs as well. Should the BDCs exposed to the tech sector be worried?
Oh, I'm going to say yes, and I'm going to say no. Let's start with the no. The pullback by the public and private capital providers in the venture area has been a boon for BDCs, who've been seeing a great deal more business from venture companies and at higher margins than before, and at less nose-bleeding valuations. And that's why you'll see that the 5 public BDCs that are involved in venture lending have grown their portfolios since the end of 2021, and many are posting record earnings and distributions. Now, back to what investors should be worried about based upon what we've been seeing at the BDC Credit Reporter. Most venture-backed companies will either barrel through or scrape through this period, and the BDCs that have funded them will benefit accordingly. However, there will be a minority of companies that have been swimming naked, as Warren Buffett would say. This will become obvious as owners decide to cut their losses. Venture companies are almost always unprofitable business by definition. Without more capital, they must and will close up. BDC lenders to them, who typically sit at the top of these capital structures, can hope to scoop up any remaining cash, sell off some assets and IP and get some recovery, but losses will occur. It's been a wonderful decade for new ideas and technologies, but not everything was going to work. And a reckoning is already underway and will amplify as liquidity dries up and is not replaced. BDC investors need to take a hard look at what's in their favorite venture BDC portfolio to determine how many duds might be there.
So interestingly, a lot of our clients in recent times have asked us if we track portfolio companies' country of incorporation. We do, and as this chart shows, the number of foreign domiciled companies has greatly increased in recent years. Do you think BDC's exposure to portfolio companies abroad will continue to increase?
Oh yeah, there'll definitely be an increase in non-US loans, especially amongst BDCs that operate in the middle and upper middle market. They tend to be part of larger asset management organizations which have a global mandate, and they want to share out those assets with all their funds that they control, including the BDCs. Selfishly, over at the BDC Credit Reporter, we're not a great fan of the BDC sector's now global footprint, because now we have to understand credit conditions in every corner of the globe. Public information about these BDC finance companies in places like Europe, Australia, or even South Africa is even more paltry than for domestic borrowers. Still, it's part of the evolving BDC landscape and unlikely to change. What we can't say, Sourav, is whether credit results would be better or worse on foreign loans and on domestic loans. This is still a very new area, and but still a small part of the broadening BDC landscape.
So finally, Nick, pull out your crystal ball. I know that in recent years, there has been some consolidation amongst public BDCs. Do you anticipate that to continue in the years ahead?
I'd like to talk about 2 trends. First, underperforming smaller public BDCs will continue to be swallowed up by bigger players, as has been the case for years, where MVC Capital, Alcentra Capital, MCG Capital, Harvest Capital, and on have been acquired by larger groups. Next up is First Eagle Alternative Credit, about to be swallowed up by Crescent Capital. However, there are fewer and fewer such BDCs to buy, so this trend will peter out. The bigger trend is likely to be medium and large-sized BDCs acquiring their fraternal non-traded BDCs where they share a common manager. Oaktree Specialty Lending has just completed just such a transaction in the last few days, turning them into a $3 billion plus player. These in-house mergers help the surviving BDCs stock liquidity, as well as helps their financing and market presence. It also allows the asset manager behind the mergers to promise with more plausibility when launching new private funds that they will have a public exit down the road. billions of dollars are likely to be involved in this trend, which should be another big boost to the AUM of public BDCs in the years ahead.
Thank you, Nick. So now in our next segment, we are basically going to be doing Q&A. So we have a few questions that has come in. So the first question that has come in, Nick, is BDCs have been absent from the public senior unsecured market. Do you expect issuance to resume this year despite higher interest rates?
Yeah, there's a public market and there's a private market. And for years, there was very little private issuance of unsecured BDC debt. And then for some reason, the markets really cottoned on to it, and they were lending to some of the bigger BDCs at rates in the 2% at one point. This year, as the question implies, that has pretty much disappeared, though there have been a couple of issuances, but nothing like it happened before. In the baby bond market, which is that public market that you're asking about, there have been now 3 or 4 issuances in the last few months from smaller to mid-size BDCs. And I expect that as various bonds sort of come towards maturity, which most of them don't until maybe next year or the year after, that we'll see more issuances again. So we're at the moment, and you can see this in the BDC Reporters fixed income table, there are 23 public BDC baby bonds. I think that the trend is going to be to build back towards 30 rather than to drop towards 18.
Thank you, Nick. Another question that came in, will the BDCs see an influx of amendments in 2023?
Oh, we're talking canaries in coal mine again, right, Sourav? Amendments, every analyst, every single conference call that I've listened to in the last few months, some analysts have said, what's your amendment level to the BDCs? Because in 2008 and in 2020, when things started to go wrong, the underlying borrowers start to have problems, and then they start going back to the BDCs asking for amendments on their covenants. That is a very good sign that credit is not going the way we want to. And so it's a bit of a drinking game, but I think the next time you listen to a conference call, I bet you that question will be asked again. But the answer so far throughout 2022 and in for the few conference calls we've had in 2023 is that there's been no pickup in amendments yet. So it's a useful indicator to see if things are going wrong. But so far, no, it hasn't happened.
Thank you, Nick. There's one more question that came in. Given syndicated loans are being replaced by private lending, do you have any sense or information about the type of restrictive provisions or covenants in the type of lending relative to syndicated loans? This would be important for ultimate recovery rates.
Yes. I mean, we all know about covenant light and how everybody, talks it down, yet everybody does it in the bank and in the syndicated loan area. Funnily enough, if you go to the latest Oaktree Specialty Lending conference call, they were just talking about this, and they were saying that there was a recent transaction where the private equity group was putting up so much money, and they were therefore borrowing so little money that they managed to get a syndicated loan with no covenants. And that was the sort of thing that the BDCs wouldn't do. So I think that the lesson in all of that is that the BDCs want to take over from the syndicated loan market, but I don't think they are going to do it in the way that the syndicated loan markets